Business owners who want to maximise their outcomes when selling their businesses need to understand the motivations of prospective buyers and the dynamics of the markets in which they operate. The best outcomes are normally achieved from strategic buyers. Those who will pay the most are usually the most to gain with the least to risk. We've divided the buyers into 5 categories, which we'll discuss in this and other videos. They are the buyer job market buyers, private investors, private corporations, private equity funds, and publicly listed companies. We'll look at each category of buyers across key price ranges. The first category we'll look at is the buyer job market buyers. They typically are looking for businesses worth less than $1 million, and in this chart they're represented by the black line. So buyer job buyers are looking for businesses that match 95% of all businesses in the market. Usually those businesses with fewer than 10 employees. So many of these business buyers want to work in the business they're going to buy. In fact, for many of them, that is the reason they're going to buy it. They value the job that comes with the business as much as the rest of the business profit. They will value the business differently to an investor who has no intention of working in such a business. So the buyer job buyers will usually pay more than a general investor for such a business. More than we can rationally value a business at on an EBIT multiple basis, because the job that comes with it is an asset to these buyers instead of a liability. So the difference between what a buyer job market buyer will pay for a small business and a general investor, we'll call it the small business premium. Now this is the market that most business brokers are active in, because it's 95% of the total market. Now these kind of businesses can be anything from the local kebab shop, hairdresser, to restaurants, other retail businesses in shopping centres, shopping malls, right through to small manufacturing operations. In another video, we've covered how these businesses are generally valued by buyers in this buyer job market category. The other 4 categories of buyers are generally $4 million plus businesses. Many successful business owners who started out themselves in the buyer job market have grown their businesses to the point where, even though they think that the buyer for their business might be another business buyer job market buyer, 20 years on, they're thinking, well, they'll take it over and just do what we did. But once you point out to the business owners who have grown their businesses into the larger scale market that they 20 years ago can no longer afford their business today, the penny drops and they realise that the buyer for their business is not going to be them 20 years ago. It's not going to be mum and dad starting out looking to buy themselves a job. It's going to be the business investor market. Because if you can afford $1 million plus business, it normally means you have either the cash or unencumbered equity to do so. And if you have those financial resources available to you, usually you're not going to want to buy yourself the job that comes with one of these buyer job market smaller businesses. The perception also that a private investor will buy a business to employ their family members is another one that a lot of business owners have. Now, whilst this is possible, it's a lot less common these days. The other 4 categories of buyers we're going to look at are all in the $1 million plus business value market. And we're going to divide them up according to their investment strategies and funding mechanisms. Many investors are hybrids or combinations of these, and some have investment criteria that are common to all groups. The categories are shown discreetly to simplify the discussion, and they are the high net worth private investors, private corporations, private equity funds, and the public companies. Now let's look at the private investors. These are typically high net worth individuals or consortiums of successful business people with surplus cash to invest to earn higher returns than they can from other forms of investments. Most private investors have a clear strategy for adding value and a mechanism for doing so. They may be seeking businesses that are underperforming. The businesses may be undercapitalised, under-resourced, or not well managed. They may have a good management and good growth plans, but lack, say, the funds to grow. They identify and provide the missing ingredients so that businesses can grow quickly. So whereas buyers from, say, the same industry would expect to leverage a business with others they might already have, private investors don't have this leverage or ability to leverage the business. So therefore, the only real attraction is a high return on investment, or a high stable return to be more specific. Accordingly, they're very price sensitive and they adopt investment hurdle rates of return that are usually higher than, for example, an industry player might have. So they'll put immediate return on investment as their primary requirement, which means that they are likely to first ask what's the price versus the profit, as opposed to, is this a strategic business for me? So these private investors, or high net worth investors in many cases, don't want to work in the businesses as we've indicated, and they are generally looking for a business already under management, or they may have a manager to bring in and put in the business. Now, if a business owner wants to sell but not necessarily immediately leave their business and is happy to stay on for a period of time, this kind of buyer may suit them. In other words, the investor can buy in and the owner will stay on for a period of time and help run the business and ultimately train somebody else to take over. So in summary on private investors, they are generally high net worth investors with cash to invest to earn higher returns than they would on other investments. They have a valuating strategy, may seek underperforming businesses, undercapitalised, under-resourced, poorly managed, looking for a way to add the missing ingredients to take the business forward, grow it quickly. They're usually price sensitive and require a high return on investment. Usually means they're going to be outgunned on a particular business opportunity by strategic industry players, if there are any. I hope you've enjoyed this video. This is one of a series running through the different profiles of buyers. If you found this video useful, please give it a thumbs up.